You remember that old song, Cotton Eye Joe? Where did you come from? Where did you go, Cotton Eye Joe? Well, today we're going to talk about the Cotton Eye Joe of accounting, the statement of cash flows. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. We're here to put the fun in accounting fundamentals. So what we want to talk about today is the fourth major financial statement, which is a statement of cash flows. So statement of cash flows cares only about one thing. It cares about the cash, the Benjamins. It wants to know, where did the cash come from and where did it go? So we're going to look at this in terms of buckets. And if we were looking at our cash bucket, all of the cash would come into the bucket and then the cash would go back out of the bucket. It would come in from our customers, would go out to pay our bills. But when we're talking about a business, we want to know specifically what areas of the business are producing cash and using cash. So we talk about this in terms of sources of cash and uses of cash. So what we're going to do is we're going to divide our cash into three different categories so that we can learn some things about what's going on with our business. So the first bucket that we are going to look at is going to be operating. The second will be investing, and the third will be financing. So we're going to sort our cash into those three different categories. Now, the operating bucket is all about the day-to-day stuff that goes on in a business. So we sell stuff to our customers, we pay our bills. That's all going to be dumped into this bucket called operating. The investing bucket is going to look at the big stuff, like did we buy a building? Did we invest in a new piece of machinery? So we're going to look at where the cash came from and where the cash went with investing. And then we're going to look at financing. So did we take out a loan? Do we have loans that we're paying on? And that's going to tell us another piece about the health of our business. And what we want to get to with the statement of cash flows is we want to look at, did our operating cash increase or decrease? Did our investing cash increase or decrease? Did our financing cash increase or decrease? And then what's the overall picture of where our cash is compared to where it was at the beginning of the accounting period? So we're going to look at where cash comes from, the sources, and where cash goes, the uses, and divide those into those three different categories. Now, why do we do this? Why is it important? Because it tells us important things about our business as far as liquidity and solvency. Do we have enough cash to keep the business going, to pay our bills, and to grow the business? So that's all coming from this cash flow piece, because it's telling us whether we're going to be able to do the things that we need to do and do the things that we want to do. Well, you might ask, can't we get this information from our income statement and our balance sheet? And let me give you a scenario that's pretty typical. So let's say that we have revenue of $10,000 and we have expenses of $5,000. So according to our income statement, we had a net income of $5,000. That should be adequate, right, to continue on with the business. But then let's jump over to the balance sheet and see what that shows us. Well, on the balance sheet, we have $1,000 in cash. We had $5,000 in profit. We had $10,000 in revenue, but we only have $1,000 in cash. And that's because our accounts receivable balance is at $5,000. So this is money that our customers owe to us. Maybe it's due, maybe it's overdue, maybe it's not due yet. But we've got a bunch of money sitting in our accounts receivable, and that's not available for us to pay bills or expand the business. Now let's say that $1,000 in cash has to cover payroll of $2,000 and accounts payable, the bills that are due right now, of $1,000. So you can see where that cash piece of it might be kind of important. And this is a pretty typical scenario, especially for small businesses. Or for a small business that gets to the end of the year and suddenly finds out they owe a bunch of taxes, and the business owner says, well, how can I owe taxes? I don't have any money. Well, this may be the secret. that business owner doesn't know because they don't understand the statement of cash flows. So when you have a scenario like that where you have bills that are due, but you don't have the cash to pay them, then what are you going to do? Well, you can get on the phone and do what I call dialing for dollars, call your customers up, say, hey, can you pay that bill? Hey, can I give you a discount and you can pay the bill today? Or you take on debt in order to cover your current expenses. You run up your credit card debt, for example. Or the owner breaks into their piggy bank and puts more money into the business. So those three examples right there are exactly the three categories that we're talking about. We're talking about operating, our customers paying us. We're talking about financing, running up some debt, or we're talking about investing where the owner is putting more money into the business. So let's talk about some of the things that would fall under that operating category. We have things like paying rent, or if we're landlords, that's our business, then we would have receiving rent from our tenants. That would be a source of cash. We would receive cash from our customers. So they're either paying us cash at the beginning of the transaction, or they're going to pay that cash to us later when we collect our accounts receivable. We need to buy inventory so that we have it to sell to our customers. And we need to pay our employees so that they keep showing up every day. So those are some examples of sources and uses of operating cash. Under the investing category of cash flows, we would have things like buying or selling a building. So you need to buy a new factory, for example. Buying or selling a piece of machinery. So you have a new piece of machinery and you're no longer going to use the old piece, so you're going to sell it. You could also be buying or selling bonds in the business. So those are all examples of investing sources and uses of cash. Under the financing category, we would have activities like taking out a loan or making payments on a loan. You may be selling stock or buying stock back, or you may be paying dividends to stockholders. Those are examples of financing in a business. A business can finance either through debt or through equity, selling stock. So the statement of cash flows takes those three different categories and says, here's the things that happened in the operating, investing, and financing sections that either increased our cash or decreased our cash. And then we're going to look at the net increase or decrease in cash from all of those categories so that we can see, here's our beginning cash balance, here's our ending cash balance. Did we increase or decrease our cash? And what this is showing us is liquidity and solvency rather than profitability. So in our income statement example where we had $10,000 in revenue and $5,000 in profit, profitability was great. 50% profitability, that's wonderful. But it didn't show us liquidity or solvency. It didn't show us whether we have the cash to pay our bills and whether we can do things like grow the business or forecast out whether we can make payroll in a month. So the statement of cash flows breaks that down for us and gives us a better idea of what's going on in the business. Now, if you're watching this video because you want to understand financial statements, your job here is done. If you're an accounting student and you need to understand how we actually come up with this report, you can go on to the other videos that show how to figure a statement of cash flows on the direct method and the indirect method so that you have a great understanding of what goes on behind the scenes in this very important statement of cash flows. Until next time, stay balanced, my friends.